Our next guest calls the U.S. the ultimate safe haven. Joe Zidle is Blackstone's chief investment strategist. Joe, great to have you with us. First of all, I want to ask you, has your investment outlook in terms of the U.S. being the safe haven here, has that changed given the geopolitics?
No, and first off, thank you for having me. And we want to acknowledge the humanitarian tragedy that is taking place in Ukraine. But in terms of an economic impact, or as we think about a fallout from it, most of the world had already been dealing with a number of headwinds, from higher input prices, from commodities and oil, to coordinated central bank hikes. And our view had been that the U.S. was an island of growth, because the U.S. is only one of the only major economies in the world that has this cushion of $6 trillion in stimulus that had effectively been created, more or less out of thin air over the course of the last 22 months or so. And that sits on household and corporate balance sheets, and it means that the U.S. has this tremendous cushion for growth as the rest of the world faces these headwinds. So I think there are risks that we'll see, higher inflationary numbers, not only from higher oil prices, but also commodities. And I think that presents a greater headwind to the rest of the world. We don't expect the rest of the world, or G7 countries or Europe, to enter a recession as a result of the higher oil prices, but we think it will be a headwind to growth. And I think the U.S. is one of the most insulated from those headwinds.
Jay-Z, it's Tim. Thanks for joining us. And I don't want to ask you about the Fed, because we're going to have a great conversation with Richard Fisher in a second. But I do want to ask you about the Fed in the context of a housing market you're very bullish on. And if I'm going to listen to anyone, I'm going to listen to Blackstone on housing. What part of this market do you get so bulled up on? We had toll earnings a couple nights ago. We've had a lot of the home builders that are essentially trading at multi-year lows at this point, or at least through the lows of the crisis. And you have a case where housing conditions still on the demand side for them looks very good. Input prices are a problem. What part do you want to invest in?
Sure, it's a great question. And when most people think about housing, they're thinking about it two-dimensionally, which is the price of a house, the median home price, and rising mortgage rates. And you see median home prices hitting an all-time high. You saw mortgage rates backing up. The 30-year mortgage recently had hit as high as about 3.95%. And so for most people, they look at the median home price and they look at rising mortgage rates and they think about affordability. Well, I think it's a little bit more than just that two-dimensional calculation, because you also have to factor in rising wages. And so if you look at the median home prices today versus pre-COVID, if you look at how mortgage rates have backed up today versus pre-COVID, it is more expensive to buy a house and to finance it, and the monthly mortgage payment's gone up, but personal income has gone up more than the increase in the mortgage rates. So I think as we consider more housing and look at housing strength, I think it's important to consider that we have strong labor markets and rising wages. And historically, housing ends up being more correlated to labor than it is to mortgage rates. So where in particular, we've seen this out-migration to the South and to the Southwest. Those housing markets remain the hottest. And I think one of the permanent changes we'll see as a result of COVID is this greater flexibility with respect to, time in the office versus working from home or working from anywhere. And I think that strengthens the case to the South and Southwestern parts of the United States. I think they continue to do very well.
Joe, how do you factor in the impact of all of this on consumer sentiment and confidence, the sort of the squishier things to try and actually calculate? I mean, you can calculate the impact per household of X dollars per gallon of gasoline, but the overall impact on the consumer psyche is something that's harder to grasp. I mean, this sort of reminds me of when economists and market strategists were trying to calculate the exact impact of the tariffs, the financial impact, but the impact on overall confidence and business outlook was completely different and much more profound.
Yeah, and we've seen a hit to consumer confidence, and we've seen the outlook deteriorate. And, there are different surveys out there, and some are more geared toward income or labor and employment markets. Others are more geared toward stock market and the value of people's assets. And so you see a difference emerging in those surveys. My view and my base case is that labor markets will continue to be strong. When you look at the shortage in labor markets, it's pushing wages higher. And as long as unemployment is falling, and I think today we have somewhere around 1.6 open jobs for every unemployed worker, I think that ought to strengthen the long-term case for the consumer. Now, the consumer's got a lot of issues that they're facing in terms of these higher input prices, and there's a lot of different things competing for wallet share. But I think a strong labor market can end up offsetting a lot of that. When people feel confident about their jobs, and when you look at the consumer net worth, most of that is anchored in the value of one's house. And so we continue to see home prices moving up. So overall, I'm pretty optimistic about the consumer. And I'd want to at least have a part of my investment strategy geared toward experiences, right? Consumer spending as we move back towards services away from goods. I think consumers are going to choose experiences over things. And I think in-person experiences will be a secular theme in the United States.
Joe Zidle, always great to speak with you.